Are you aware of the benefits of investing through an Opportunity Zone fund? If not, you may be missing out on the greatest tax benefit ever offered by the U.S. Treasury. Have you recently realized, or are you about to realize, a capital gains event? Perhaps you have heard about Opportunity Zones, but do you know how they work? And how can they be better than a tax deferment strategy like 1031 exchanges and Delaware statutory trusts? Are you ready to minimize and eliminate most of your future capital gains taxes? If so, then keep watching so that you don't miss out on the best federal tax break ever offered. To benefit from investing in Opportunity Zones, the investor must invest their capital gains into a qualified Opportunity Zone fund, also called a QOF for short. Within the QOF, its fund manager then buys and sells assets located within Opportunity Zones by investing in qualified businesses and properties. If the investor's funds stay in the fund for 10 years, then they earn a 100% step-up in basis on all future gains. Translated, that means no more taxes. So let's look at a specific example and see how it can be better than a tax deferment strategy, such as a 1031 exchange. For a simple example, let's say an investor realized $100,000 in capital gains recently. In this case, they presently have about a $20,000 tax liability due to the IRS by the time they file their next return. Let's also say, for simple math, that the investor expects to earn over the next 10 years a 17.4% internal rate of return. For the case of a tax deferment strategy, if an investor defers their taxes for 10 years, assuming the tax rate stays the same, then they will eventually have a tax liability of $100,000 instead of just $20,000. But if they invest their original $100,000 into a QOF, the future gains are free of any capital gains tax if held there for 10 years. In this example, that means the $400,000 gain is tax-free. In addition, the investor also gets to defer their present tax liability until 2027, so their $20,000 tax liability continues to work for them for the next few years, improving the time value of their money. Then, over the 10-year span, the investor only pays a total of $20,000, not $100,000. And if they leave their investment in the fund even longer, they continue to receive the step-up in basis and pay no capital gains taxes on the additional gains. And to help the investor pay for that original tax liability of $20,000, which is due now in 2027, the fund manager can also return up to 100% of their original investment tax-free. It's tax-free because, in fact, it's a return of capital. For more information, come see us in our booth, number 107, or contact us at fundmanager@sceniczone.com. Our website is https://sceniczone.com. You can also scan the QR code here to visit South Silver Group online and to register your contact information and investments interest